Stocks continue to flirt with record highs, albeit within a narrow trading range. And while the markets are trading slightly above their historical averages, are stocks really that expensive given the low interest rate environment? Kevin Kelly is the Chief Investment Officer at Recon Capital Partners and joins me now on set. And Kevin, the S&P 500 is trading slightly above its historical average. But are stocks really that expensive given low interest rates, which has helped stocks?
Yeah, one of the arguments that stocks are expensive is because they're typically trading above their historical averages, but those historical averages were in 6, 7, 8% interest rate environments. So if you look at what companies are doing now in their earnings and their growth, those earnings are actually worth more. So that's why they can trade at a premium, because the cost of capital is lower. So every earnings that they have is now worth a lot more. So people should pay up for that.
All right, and do you see a correction coming perhaps this summer as investors look for the Federal Reserve to hike interest rates possibly in September?
It's really hard to see a correction coming, especially given where we are with the low interest rate environment. But unemployment is so low right now, and what's actually really encouraging about this market is everyone is calling for a correction. So normally when you hit all-time highs like this, euphoria is abound and no one can see it coming. But now everyone's worried and tepid, so that means people are investing judiciously.
All right, let's talk about life after the Fed's rate hike. We had Wharton professor Jeremy Siegel on CNBC saying, look, fourth quarter is going to be the best quarter of the year for stocks if the Fed tightens in September, because investors will say, look, that wasn't so bad, and they'll flood into stocks. Do you agree?
Yeah, so the crux of his argument was that when the Fed does rise, it's going to be 25 basis points. That's really de minimis overall. That's not a huge interest rate bump. They'll do it slowly. Backing up his argument is if you look at the Fed funds future rate at the end of 2016, it's pegging that it's going to be less than 1%. So the whole thesis is interest rates are going to be low for at least till the end of 2016. We do have an election, so it's a great time to get in, especially into adequately priced sectors like tech and healthcare that are growing.
All right, so with that, what is your strategy? What names do you like?
Strategy is to stick with those names in tech, healthcare. There's also names overseas that you can look at. InterContinental Hotels Group, it's adequately valued. Some find it a value play. So there's a lot of mergers going on overseas. You can see in the chip space. Starwood actually fired their CEO. They hired strategic advisors. InterContinental is the actual best name that they could acquire and assimilate into their company.
And in the chip space, anything else?
Yeah, in the chip space, you need to look at ARM Holdings, right? ARM Holdings, profits grew 22%. They're doing very well. Nvidia, Qualcomm, they're actually customers of ARMH. So it's traded over here in ADR form. They're growing. They own 95% in this new smartphone, 64-bit processors. Great name.
All right, Kevin Kelly, thanks very much for coming in.
Thank you.
I'm Scott Gamm, and you're watching The Street.